When you step back and look at the global financial system as a whole, it becomes clear that XRP is not approaching an important phase because of hype, price cycles, or social media narratives, but because the underlying structure of global liquidity is beginning to change. And when liquidity changes, assets that exist purely as speculative vehicles tend to suffer, while assets that were designed to move value through stress systems start to matter more. That is why the idea that the Japan carry trade is unwinding and crypto could crash is not a dramatic or emotional claim. It is a logical conclusion drawn from how leverage, capital flow, and settlement infrastructure actually function in the real world. If the largest, cheapest source of global liquidity begins to reverse, capital does not disappear evenly. It retreats, it consolidates, and it looks for systems that can survive under pressure. This is the context in which XRP needs to be understood. For decades, Japan's low and negative interest rate environment quietly acted as a pressure valve for global markets. Capital could be borrowed cheaply, sometimes even at a net gain, and deployed elsewhere in higher-yielding environments. This was not an ideological trade or a speculative belief system. It was math. When that math worked, liquidity expanded across stocks, real estate, and crypto. When that math stops working, the unwind does not ask which assets are popular or which narratives are loud. It asks which assets are liquid, which can be sold quickly, and which positions were built on leverage rather than necessity. That is why the question is not whether crypto could experience stress, but which parts of crypto were built to exist when leverage is removed from the system. When the Japan carry trade begins to unwind, what the global market experiences is not a sudden emotional shock, but a structural shift in how liquidity moves through the system. For years, capital sourced from Japan was among the cheapest in the world, allowing institutions to borrow at extremely low or even negative rates and deploy that money into higher-yielding environments elsewhere. This created a steady expansion of liquidity across asset classes, including equities and crypto, not because those assets suddenly became more productive, but because money itself was abundant and inexpensive. When that condition changes, the system does not respond with panic, it responds with mathematics. Costs rise, margins compress, and positions that once made sense under cheap liquidity begin to fail under tighter conditions. This is why the unwind of the Japan carry trade should be understood as a liquidity event rather than a narrative event. Markets do not reprice because headlines become frightening or because sentiment turns negative. They reprice because the underlying flow of capital changes direction. When borrowing becomes more expensive in Japan and returns elsewhere narrow, the arbitrage that once justified massive leverage positions disappears. Institutions are then forced to reverse those positions, not as a matter of opinion, but as a matter of survival. This reversal pulls liquidity out of markets that benefited from the trade, and it does so unevenly. Assets that were easy to enter and exit, particularly those held for return rather than necessity, become the first to feel pressure. In such an environment, it is misleading to frame market movement as a collapse driven by fear. What is happening is a recalibration of value based on function. Liquidity-driven assets that existed primarily because capital was plentiful are reassessed once capital becomes scarce. This reassessment does not discriminate between popular and unpopular assets. It discriminates between essential and non-essential ones. The market begins to ask a different set of questions. Which assets enable institutions to operate under stress? Which systems reduce risk rather than amplify it? Which mechanisms allow value to move efficiently when capital can no longer sit idle? The answers to those questions determine how capital flows during a liquidity contraction. Selling pressure is not random, it is strategic. Institutions unwind positions that no longer serve a structural purpose and preserve access to tools that maintain operational continuity. This is why liquidity events feel slow and methodical rather than explosive. They unfold as capital retreats to efficiency. Understanding this distinction is critical because it explains why market stress does not necessarily imply systemic failure. It often signals a transition from abundance to discipline. Seen through this lens, the unwind of the Japan carry trade is not the end of markets or technology, but a test of design. It reveals which assets were supported by leverage and which were built to function when leverage disappears. The market's response is not emotional or ideological, it is procedural. Liquidity moves away from fragility and toward utility. Recognizing this allows observers to interpret market behavior not as chaos, but as a rational adjustment to new financial realities. When liquidity tightens and markets come under stress, the distinction between speculation and infrastructure becomes unavoidable. During periods of abundant capital, this distinction is often blurred because money flows freely and inefficiencies are tolerated. Assets rise together, correlations increase, and valuation becomes detached from function. Crypto markets in particular thrive in these environments because speculation can persist without immediate consequences. However, when a liquidity contraction occurs, the system begins to differentiate. Capital becomes selective, risk tolerance declines, and assets are evaluated based on what they actually do rather than what people believe they represent. This is why periods of crypto stress are not simply downturns but sorting mechanisms. Networks that exist primarily as vehicles for price appreciation rely on constant inflows of new capital to sustain their valuation. When those inflows slow or reverse, their lack of functional demand is exposed. The technology may still exist, but the economic justification for holding the asset weakens. In contrast, blockchain networks that provide essential services continue to be used even when market conditions deteriorate. Their activity does not depend on optimism, but on necessity. Settlement still has to occur, value still has to move, and systems still have to operate. The idea that a broad crypto downturn invalidates blockchain technology misunderstands how infrastructure develops. Roads are not judged by how popular they are during traffic surges, but by how reliably they function during constraints. In the same way, financial infrastructure is revealed during periods of stress, not euphoria. When leverage unwinds and speculative positions are reduced, what remains are the systems that institutions cannot afford to abandon. These systems are not immune to price volatility, but their relevance persists regardless of market sentiment. This separation becomes particularly clear when institutions reassess their exposure. Speculative assets are treated as discretionary, while infrastructure is treated as operational. The former can be sold without impairing functionality, the latter cannot. This dynamic explains why some blockchain networks experience declining usage during downturns, while others maintain or even increase activity. The difference lies in whether the network solves a real problem under constraint or simply performs well when capital is plentiful. Importantly, this process does not require ideological judgment. It does not matter whether an asset was marketed as revolutionary or conservative. What matters is whether it reduces friction, lowers risk, or improves efficiency in a system that is becoming more disciplined. As liquidity contracts, markets prioritize resilience over novelty. Assets that were tolerated during speculative phases are scrutinized, while those embedded into workflows gain relative strength. Understanding crypto stress as a filter rather than a failure reframes how market movements should be interpreted. A downturn does not mean the end of innovation. It means the end of indiscriminate valuation. The market is not rejecting blockchain technology, it is refining it. In this refinement, infrastructure survives because it is needed, not because it is believed in. Speculation fades because it requires conditions that no longer exist. This is how financial systems evolve, and crypto is not exempt from that process. XRP's value proposition becomes clearest not during periods of exuberance, but during moments when financial systems are under constraint. Unlike assets whose relevance depends on optimism or belief, XRP was designed to address specific operational problems in global finance, particularly those related to liquidity, settlement speed, and cross-border efficiency. These problems do not disappear when markets tighten, they become more visible. When capital is abundant, inefficiencies can be ignored. When capital becomes expensive, every inefficiency is exposed, and systems that UCE friction gain importance. At its core, XRP is not positioned as an investment thesis built on narrative, but as a tool built for function. Cross-border payments, require pre-funded accounts, time delays, and counterparty risk in traditional systems. These costs are manageable when liquidity is cheap, but they become burdensome when interest rates rise and balance sheets are scrutinized. XRP offers a mechanism to move value between currencies without requiring capital to sit idle. In an environment where liquidity must be optimized, this capability shifts from optional to valuable. This is why XRP's relevance is tied to institutional behavior rather than retail enthusiasm. Institutions do not adopt technology because it is popular. They adopt it because it improves efficiency under regulatory and economic constraints. XRP was designed to operate within those constraints, not outside of them. Its ledger architecture prioritizes fast finality, predictable transaction costs, and reliability at scale. These characteristics are not abstract ideals. They are requirements for systems that handle real money. When leverage unwinds and risk models tighten, institutions gravitate toward tools that reduce uncertainty rather than amplify it. The question of why banks would theoretically want XRP to be expensive is often misunderstood because price is usually discussed as a speculative reward. In a liquidity bridging context, price serves a different role. A higher priced asset can move larger amounts of value with less volume, reducing slippage and minimizing the capital required to facilitate transactions. From a system design perspective, price efficiency enhances usability. This does not imply a desire for volatility, but for stability at a level that supports scale. In this framework, valuation is not detached from function, it is a component of it as liquidity condition. Tighten globally, the appeal of tools that compress settlement time and reduce capital requirements increases. XRP's design aligns with these priorities. It does not rely on ideological purity or resistance narratives to justify its existence. It relies on solving problems that persist regardless of market cycles. This distinction matters because systems built for utility tend to survive transitions, while systems built for speculation struggle when conditions change. Understanding XRP through this lens reframes its role in the broader market. It is not positioned to thrive because others fail, but because its use case becomes more relevant as financial discipline returns. Utility under constraint is not glamorous, but it is durable. In environments shaped by tightening liquidity and increased scrutiny, durability is what determines long-term relevance. Price becomes meaningful only when it reflects function, and this distinction is critical when evaluating assets in a tightening financial environment. In speculative markets, price often moves independently of utility, driven instead by momentum, leverage, and expectation. These conditions allow valuation to become detached from what an asset actually does. However, when liquidity contracts and leverage unwinds, price is forced to realign with use. This is not a moral judgment by the market, but a mechanical one. Capital becomes more selective, and assets are repriced based on their role within the system rather than their popularity. In this context, understanding price as a consequence rather than a prediction changes how value is interpreted. Predictive price targets rely on assumptions about future sentiment, while consequence-based valuation emerges from adoption, integration, and necessity. When an asset is required for a process to function, demand is structural rather than emotional. This type of demand does not disappear when narratives fade. It persists because the system depends on it. As usage grows within real workflows, price adjusts to accommodate scale, liquidity, and efficiency. The adjustment is gradual and often misunderstood by observers who expect dramatic movement driven by speculation. For utility-driven assets, valuation serves a practical purpose. In systems where an asset is used to transfer value, price influences how efficiently that transfer can occur. Higher valuation can reduce the volume needed to settle large transactions, lowering market impact and operational friction. This dynamic has nothing to do with excitement or hype. It is a function of system design. Price stability at appropriate levels supports reliability, which institutions prioritize over short-term appreciation. When assets fulfill a role in infrastructure, their valuation reflects the size and importance of the system they serve. This is why speculation is an unreliable foundation for long-term value. Speculative interest is sensitive to liquidity conditions and reverses quickly when capital becomes scarce. Utility-driven demand, by contrast, is less elastic. It grows as systems adopt and integrate the asset into their operations. The market recognizes this over time, not through sudden revaluation, but through sustained repricing as usage expands. Observers often mistake this process for stagnation because it lacks drama, but it represents alignment between price and purpose. The broader implication is that market downturns do not eliminate value, they clarify it. Assets that relied on expectation are exposed, while assets that deliver function continue to be used. Price in this environment is not a reward for belief but an outcome of relevance. It reflects how indispensable an asset has become within a network of economic activity. This perspective explains why focusing on price alone can be misleading. Without understanding the underlying drivers of demand, valuation appears arbitrary. Over time, systems reward assets that integrate quietly and reliably. The market eventually acknowledges this integration through valuation, but only after usage has proven durable. Those who look for price signals before understanding function often arrive late, interpreting the result as a surprise rather than a consequence. In disciplined financial environments, price follows necessity, and necessity follows utility.